Coming up, the Reserve Bank losing patience with inflation and where Aussies are doing business overseas changing. That's coming up. It is your daily 10-minute business and finance news wrap for this Tuesday, the 17th of October 2023. Later on Market Day, we will speak with Martin Lakos from Macquarie. But first, let's talk about trade. And we had some statistics and a survey from the Australian Chamber of Commerce and Industry. So while Australia's trade relationship with China is improving, its imposition of barriers on exports like barley, wine, coal, lobster and beef in 2020 has hit its reputation as a place to do business. So for the first time, the US has overtaken China as the most common trading partner for Australian businesses, followed by Singapore, New Zealand and the United Arab Emirates. For more, I spoke with ACCI's CEO, Andrew McKellar. Andrew, the US has jumped China as Australia's business leading trade partner. Why?
Well, look, I think there's a number of factors, but clearly one of the things that's influencing those businesses that are responding in this survey, we've seen a number of trade measures being imposed on Australian exporters over the past several years. Clearly, that's had an impact. Many of them are looking to diversify their markets. And as a result, we're seeing another major trading partner, the United States in this case, jumping to the top of the list. Now, China is still there. It's still number two. But for the first time, we've seen it displaced in this survey by the United States.
You've got the likes of Singapore on that list, New Zealand, even the UAE. I mean, are there any trends that you've noticed to come out of this report with where Australia is wanting to do business and why?
Well, I think there's a couple of factors. I mean, businesses are responding, I think, to the pressures in supply chains that they've seen over the past couple of years in particular. So diversification is one of the top themes that many of the survey respondents are coming back with. And we've seen, that they are obviously wanting to look at either new markets or perhaps established markets, but putting some emphasis there on markets that they haven't paid so much attention to in recent years. Now, the UAE, you mentioned, that's one which interestingly has jumped up in the survey in the past 12 months. We haven't yet seen emerging markets or areas like India. There are big opportunities there. We've got a new trade agreement in place with India. We're trying to negotiate a more comprehensive agreement. So I think this is something that will be interesting to see as we go forward over the next few years, whether markets like that also come into the picture.
And finally, what are businesses telling you about what's stopping them from doing business overseas and what can be done about it?
Well, certainly, there's a couple of factors that businesses are citing. Now, international competitiveness, what does that mean? When we dig into that a little bit, what we're hearing is that supply chain disruptions over the past 12 months have been a big factor. That's been, in many cases, pushing up costs for businesses. A lot of them don't have other options, so that is compressing their competitiveness. So that's been one of the issues that business has been grappling with. The other one is skills shortages. Now, that's true whether it's domestic industry, whether it's export-oriented industry, but that international competitiveness factor and skills shortages, those are the two big things that I think are really putting some pressure on businesses at the moment.
McKellar there from the Australian Chamber of Commerce and Industry.
Now, Market Day on the SBS On the Money podcast.
The Australian share market rose today. The S&P ASX 200 up 0.4%. That's despite the RBA minutes for the October board meeting released today, saying that a rate rise is still on the table in the future. It is data dependent, namely inflation. Adding today that the board has a low tolerance for a slower return of inflation to target than currently expected. For more on the day's market action, I spoke with Martin Lakos from Macquarie.
The lead from the US markets was pretty positive. There's no doubt about that. And through our time zone, there's been some more news around diplomatic efforts of what's going on in the Middle East. So I think markets are hoping that things aren't going to escalate any more than what we currently know of in the region there. And of course, there is some news that President Biden may actually go to Israel and also meet up with some of the leaders there. So that's assisting the risk off perspective on markets. So a better day for the Aussie market.
You mentioned Joe Biden there. How worried are you, or how worried is the market about the implications of that Middle East conflict?
Well, again, it's all about, whether we see escalations and other groups coming into the fray. Obviously, we don't want to see that at all. We'd like to see that to start to settle down. But, clearly there's some expectations that this conflict is going to continue to some extent. And there's been a lot of news around that. Look, from an economic perspective, unless we saw some big oil players or disruption to oil production, this conflict, appalling as it is, basically won't have major economic ramifications outside of changes of say, oil producers as an example. So, look, it's important. It doesn't help sentiment or confidence. And obviously, it just adds to geopolitical risks that we've already got around the world.
So oil's one commodity in energy. What about iron ore? Iron ore prices staying above 120 US. I think that's on talk of some stimulus out of China. What's your take on the economy there?
It does appear that the Chinese are looking through their bond markets basically to raise about a trillion yuan, so significant amount of money, and that basically is going to be designated more towards infrastructure spend, and hence that's giving some support to iron ore pricing as a result of that, because obviously more stimulus by Chinese authorities around infrastructure will continue to support that price. There's absolutely no doubt, though, while talking on China, to some extent, the stimulus packages to date have been muted. Certainly they haven't gone out with a bazooka, which has probably been a good thing, but I think there's some recognition that there needs to be more to be done supporting the Chinese economy and sort of a recovery from the zero COVID situation and that slow decline in economic growth that's been taking place through late last year in the Chinese economy.
Also out today, the RBA October board meeting minutes. It basically said, hey, we considered a rate rise, but we decided to keep rates on hold at 4.1%. But it was also implicit in saying, hey, there could be another rate rise depending on future data, particularly inflation. And it seems to be talking tough on inflation too. What does the market think about the future direction for interest rates, particularly after this statement too?
Well, certainly the last board meeting where they had the opportunity to raise rates again, given when you have a look at the makeup of inflation, so the goods side seems to be coming under control to some extent, but also you've also got the services side still being very, very sticky. And that opportunity wasn't taken up by the Reserve Bank. So really, to some extent, we've got to see what the data is on the September quarter numbers. That's due out on the 26th of October. So there is definitely a caveat around what the central bank might be doing on interest rates. It's certainly Macquarie's view now. We've changed our view that we're now at the peak at 4.1. But, it's very much going to be data driven to see whether the services component starts to come down as well. And what is that services component? Well, it's things like rent, wages, power costs, all those sorts of areas. And so they are being a bit sticky at this stage.
That is Martin Lakos there from Macquarie. This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.